Welcome back to another episode of Palisade Radio. I'm your host, Karema Mutlu. And on today's show, we welcome back Jaime Carrasco, who's the portfolio manager at Canaccord Genuity. How are you today, Jaime?
Doing well. Thanks for having me back. It's been a while.
The last few weeks have seen a dramatic rise for gold, with gold in many currencies going back to all-time highs. So is there a price discovery taking place for gold right now, Jaime?
Well, I think we're going to have a pretty good answer to that question by next week for the simple reason that this is the first time in years, and I repeat, in years, that the contracts for options and futures are expiring yesterday and today, and they're expiring at a much higher value than the average contract has been written over the last while, which is about $13.50, $13.60, I would imagine, and we know that from the commitment of trader reports, and a lot of shorts have been added over the last, couple of months or so to try to keep the price below that mark. And we're sitting here at $15.24 right now on the rollover, so a good $150 higher, which means that a lot of those contracts, as Warren Buffett likes to say, we will know who's been swimming naked, because there's some massive shorts against those contracts as the rollover occurs. So next week, I think we'll get a better picture. Every time we get to the options, there's a big facade, a lot of window dressing where they're trying to bring the price down to roll over the contracts. And so because of that, I don't want to speculate right now until next week, but things are definitely looking very bullish. Definitely not many saw the price jumping higher. And I think it's also indicative of the systemic risk that we're facing currently with a lot of things.
Very good. And I'd like to point out we're recording on Friday, the 16th of August. Okay, let's move on and talk a bit about Ray Dalio. He has suggested that there is a paradigm shift going on within the markets, and part of this new shift should include gold. You've been saying this for a long time, that gold needs to take center stage once again and be brought back into a monetary system. So did Ray Dalio's comments surprise you, Jaime? And what effect will this have on the average investor who perhaps is looking at gold for the first time?
Well, I think Ray Dalio's comments were quite interesting in that I've been talking about a paradigm shift for quite a while, and the paradigm shift that I'm talking about is the end of the currency reserve. I've been saying that the current system, fiat system especially, can't continue to work because it's been pile on of debts. Every time we get to these kind of situations, the currency reserve has to be dealt with because the only way is to devalue it. I read the piece by Ray Dalio, and it was quite long and intricate economic-wise and history-wise, but it was describing the same thing that I've been saying in the piece I wrote, one of my first pieces that I posted on LinkedIn, about the paradigm shift that was occurring. Now, he's on the right track, and I think timing is also correct in that we seem to be here. We're witnessing it with, 16 trillion now in negative interest rates, which has never happened in the history of civilization. What that means, though, is that I'm going to lend you money, but pay you back less money you're going to pay me back less money than I lent you. Now think about the pension funds that are having to buy that. I would call it a different word than a grade A quality investment, right? Even though the government bonds that are being traded, but think about pension liabilities and the system. It's unbelievable what's happening, and that's 16 trillion reasons to add gold. Gold is the only asset that is nobody's liability, right? When we're looking at 16 trillion of liabilities that are negative yielding, I think a lot of pension fund managers at some point are going to have to move into gold to cover or hedge some of those bond positions. It's the bond market that's the problem. I keep saying that, and it just keeps getting worse. And by the way, that number is going to continue escalating as we head further and further into the next economic recession, which is coming. Right, and because of that, I think I'm very bullish gold as protection, and the light has definitely gone on. Within that, it's the bond market, and the financial sector as well is signaling similar things. Look at Deutsche Bank; it's trading at what is it this morning? Hang on, 6.57. So it's again below the €6 mark. So a lot of things are looking, look at what came out of GE or just over this week. Every week is as though more and more negative factors keep piling in, and there's some dismissal on behalf of people, but I think eventually it might become an avalanche. The when, again, I don't want to speculate when. All I've been doing is positioning my clients and myself as a hedge or to benefit from the negative side of this climb we've seen.
Talk to us about the Dow versus gold ratio, Jaime, and the significance of this and what now might be taking place. I know this is a major indicator that you like to focus on. Can you give us some more details?
The reason for it is because of investor participation in the sector. What it's really signaling is the fact that less than 1% of 1% of investors own any precious metals. That's the most important signal, right? One of the things that a lot of people that have been buying these assets are saying now, oh, we've had the bump up, maybe I should pull some money out. My opinion is, just be patient, hold on to your position because nobody owns this sector. The participation among, if you compare it to the Dow or other investments is almost nil, right? Nobody really owns it. So I would wait until we get more investors coming into this trade before I even worry about it. Another issue that actually must be pointed out from a historical perspective is that the markets could continue rising because what we're witnessing is a flight for safety. So within that, when you look at the global spectrum, things are not good in Europe. There's a lot of issues in Asia. Look at what's happening in Hong Kong, the geopolitics. So the U.S. is a safe harbor. The U.S. dollar is a safe harbor. And definitely U.S. treasuries are a safe harbor, but so is gold, right? But gold is the least known of that. Now, that's important to point out because we could have the U.S. stock market continue to rise, but so will gold and so will the U.S. treasuries as money seeks safety. Now, why do I bring this up? Because there's a historical fact that all of these type of corrections have always finished when the Dow and gold are at the same value. 1930s, 35, 1980s, 800, 800. Is it going to be 50,000, 50,000, 30,000? I don't know. But I'm betting that the number for gold is much higher than this, and that's why the ratio that you just pointed out makes a lot of sense. Another ratio I would be looking at as well is the gold-to-silver ratio, because that gives me a better visibility of the true opportunity within the sector itself and why I like silver much better. Right, I think gold has been neglected and silver has been completely forgotten, and because of that, I'm more gearing towards silver than gold.
In our previous interview, Jaime, at the end of 2018, you spoke of the possibility for high interest rates, and interest rates have since gone down. So, what are your views on this today, and should we expect much lower interest rates to continue?
I was wrong about rising interest rates, even though I think at some point we will get rising interest rates because people are going to realize that these debts are unpayable and it's garbage, right? For now, though, it's the perception of safety, the perception of where to put money away, that it'll be there tomorrow or the next week or a month from now, and the U.S. Treasury is definitely there. What that means, though, is that we're going to get further and further destruction from the bond market. You see, the fact that rates are at zero and going lower is not a good thing either, because you're not losing it on the you're not losing it on the interest rate side. You're losing it on the principal side, right? So again, the payment at the end of the maturity of these bonds is going to be negative, and I'm talking about negative yielding bonds. So we are getting destruction within the fixed income market on both sides of the equation, whichever way we look at it. So to some extent, it's also signaling bad days for the bond market, and that is the problem. The fact that the bond market way out, the nominal figure of debt is way bigger than the equity markets. Think about something. We have now $17 trillion in negative interest rates. Well, global debt is sitting at $246 trillion, so there's a lot of debt to go negative still, right? So that bubble will continue imploding for, I think, quite a while longer.
And if we are to believe that gold is back in a bull market, what would you say you've learned as an investor throughout the last few years, especially within this bearish phase for the precious metals and particularly the mining stocks, Jaime?
Well, the first thing that I would say is the fact that what I've learned is the ambivalence or the neglect of all our investors with regard to this sector. Nobody wants to talk about it. Nobody wants to talk about the overvaluation in the stock markets. Everybody wants to talk about how much money they've made in the stock market as opposed to take some money off the table. From the gold perspective, which is the sector that I like the most, is the fact that nobody owns it, right? The fact that everybody that has had the patience to build positions right now, you might as well sit on them because they are safe harbors. One of the cautions that I would make is how hard will it be for people once the light comes on to get to themselves to 5% in the sector from as a percentage allocation of their investable assets. Now, 5% is the minimum that is Ibbotson recommends as a safe percentage of your assets to be invested in the sector. I have clients at a minimum of 20% now. So how hard will it get for investors to even get themselves to 1%? They might buy 100 shares of Barrick and Goldcorp because those are the two names that their advisors are going to like. But to get themselves to anywhere near 5% is going to require quite a lot of more guts to do it. So, it won't be easy jumping into the lifeboats when the time comes. So my advice is for those that are in, hold on until people start to come in. For those that are not, you have some serious thinking to do in terms of how to reposition yourself. The other problem that I think we face is I personally think we're running out of time. I'm always reading the page 16 part of the paper, like Epstein. Until about a week ago, that was noise within the media. Today's frontline headlines. Now, all of these things have a way of coming around and becoming part of the ethos of society, and eventually the change occurs where we go from trusting to no trust. At what point does that catalyst kick in, right, where the pendulum finally swings the other way? I think we're getting very close to those points. I'm seeing that because the signals that the market is giving me, both from negative interest rates or some stocks like Deutsche Bank or GE and so on, they start to add up, and sooner or later the scales turn and it becomes an avalanche. So preparedness would be the one thing, and patience is the other. I've bought, Jesse Livermore used to say, buy right and sit tight. Well, I've been building those positions for the last 2 to 3 years, and it hasn't been easy. It hasn't been easy for clients to be sitting in positions that nobody wanted because the stock markets kept going higher and higher. And that's the hard part to do. And when it comes times to doing that, it's going to be very hard for investors once they decide to switch.
Okay, it would also be great to find out what books have helped to shape your career within your thinking for the markets, Jaime. And is there anything you're currently reading today that you can share with us?
For sure. I highly suggest everybody pick up James Rickards' latest book, Aftermath, and follow that up with DiMartino Booth's Fed Up. Both of those will give you a really good assessment of where we're at and the mess that we face and how we got here. On a long-term basis, I got to go back to my standards. Gold Wars by Ferdinand Lipp's old Swiss banker wrote it. It's the best history of gold as money and why it works. The Great Wave by David Hackett, which is, again, the Bible of long-term cycles. And on a fiction side, Atlas Shrugged, 1984, all of the great books, even anything by Hemingway. Hemingway lived through the last time we went through this, which was the 30s, and there's some sage advice that was written down and left for us to follow. And that's why I think some of the good fiction from back then makes a lot of sense.
Is there anything else you wish to discuss with us today, Jaime? Anything else on your mind?
I think that right now people should be thinking outside the box, create your own narrative of what's going on, because I find that there's quite a bit of misinformation out there, or lack of wanting to really see what the true risks in the system are. And someday that light's going to come on, and I think it's coming on very quickly, and you're going to get caught on the wrong side of the trade. And I do think that, go back to 2008. We haven't solved anything. All we did was create a bigger problem because we tried to solve the debt problem with more debt. And I think that's what's coming out loud now. It's like, oh, what do we do now? We're sitting at $240 trillion worth of debt from, what was it, 100 trillion, 110 trillion back in '08. The shadow banking system was sitting at 20 trillion. Now it's at 56 trillion. So all we've done is pile on the leverage. And I think that has consequences when you look at the world from a fixed income side.
Excellent. Okay, well, thank you once again, Jaime. Always great having you on the show.
It's always a pleasure.
Think you understand the junior mining sector and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be, it actually could be quite violent. It could be a rip-your-face-off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen?